Today, CNBC unveiled the inaugural Financial Advisor 100 list, and Carret, Wayne's firm, coming in at number 14 on our list of top firms. So congratulations on that, and welcome.
Thank you very much.
And it's great to have you both here. Nancy, fascinating discussion with Derek and Michelle there just now. Tell me, as an investor, what you're going to do about this.
Yeah, I mean, you're going to rethink the model, I think, from here. But I also, we're not investing short-term on China tweets or trade innuendo.
But is it harder if you're investing in the long term? Because what now are you trying to factor in for those China numbers?
Yeah, I mean, I think we're going to see supply chains move slowly over time. I think there's going to be sort of change at a glacial speed, but I do think it changes the framework. I agree with Michelle. I think she's been right on this issue all the way through. Our relationship is changed with China, and I actually think that's a good thing.
Well, in terms of the U.S. interest, but there's so many different mega companies, Wayne, obviously, like anybody you look at and have to figure out, well, what's their exposure going to be in China? How big a presence are they going to have there? How do you make that calculation now?
We're setting our parameters lower on earnings, and if we still like the company based on cash flow and those earnings, then we're comfortable going for the longer term. But the way earnings are going to come in right now, down this quarter, and I'm concerned a couple of companies that reported already today, Delta, Philips Electronics, guided lower. And so we're going to set our sights a little bit lower on earnings, but we could still like companies.
Sure. And do you use those opportunities and say, okay,
absolutely.
well,
Absolutely.
This is going to be a near-term pullback? I mean, how bearish are you about the U.S. economy at this point?
We don't expect a recession or a bear market, severe bear market, but we're definitely cautious here because, as I said, we have valuations that are high because of low interest rates, and we have a slowing economy, and we have corporate earnings, which I'm very concerned about, as I said, based on the reports I'm getting from companies and the companies we talk to.
What's the main thing you're hearing from clients? Are they nervous about being in the stocks? Are they nervous about being in bonds? Are they feeling just fine? I mean,
I have a lot of high net worth clients, and they're very circumspect. I think, this cycle, for the market to be where it is, normally they're getting more speculative juices going at this stage and looking at IPOs and what do you think of this and what do you think of that. We're not seeing that. They're very comfortable having cash reserves. So I'd say our short-term investments, cash reserves are pretty high.
Wow, okay. They're restrained. And Nancy, that, again, I wonder feeds into this idea that this whole cycle can be longer and, yes, slower than previous ones. And the IPO point is really interesting. We've seen a lot of the kind of heat come out of there, but it's not to say it's over. Next year could bring Airbnb and a host of other companies. How, boil it down, how do you position?
Well, so we buy companies on a relative valuation basis, and we're also looking at the dividend, Kelly, because managements of these companies set the dividend based on free cash flow or normal sustainable earnings power as a portion of. So I'm less concerned about earnings. We're watching the top line. And we are finding attractive valuations in cyclicals. And so when I was here last, I was talking about software. Before that, it was consumer discretionary. We've been trimming back the consumer discretionary and moving more into tech and some of the more cyclical names. It's a bit contrarian. But
it absolutely is on the cyclical piece of it. But you're comfortable with the fundamentals there?
Yeah, we are. I mean, I think a lot of it's already priced in.